Welcome to today's explainer. Now, if you're noticing our dynamic anime-style visuals and vibrant colors today, there's a very good reason for it. We are diving straight into what looks exactly like a high-stakes animated showdown ripping through the crypto markets on August 14th, 2026. It's a massive, intense tug of war between opposing financial forces, and that's exactly what the data is showing us today. So jumping right into the action, the absolute biggest question on everyone's mind today is, why is crypto completely frozen right now while global markets are absolutely heating up? I mean, we're seeing global equity markets hitting all-time highs, yet Bitcoin is just trapped in this tight, sluggish holding pattern. To understand this gridlock, we really need to look at the massive opposing energies currently locked in combat. Section 1. Macro forces collide. Okay, so on one side of this clash, we've got some serious bullish energy. U.S. inflation just cooled off, with the producer price index dropping to 4.7%. That's the lowest it's been since March, and it essentially sent a massive jolt of risk appetite straight through traditional finance, pushing the S&P 500 to record highs. But countering that, we have a heavy bearish wall. The geopolitical friction from an indefinite U.S.-Iran naval blockade in the Middle East is driving up oil prices, and that's totally killing the appetite for riskier assets like crypto. Caught directly in the middle of this crossfire is Bitcoin. It literally failed twice today to break through that heavy resistance zone around 63,900. It actually took a hit, tumbling down to 62,800 before pulling off this sharp, dramatic V-shaped recovery to hover right around 63,500. It's basically a perfect representation of two equally matched market forces resulting in a standoff. Section 2. The volatility squeeze. Now, this overarching macro tension is heavily compressing the crypto market. Plus, today brings a massive expiry event on the derivative side. We're talking about 20,000 Bitcoin options expiring. That carries a notional value of $1.29 billion. Combine that with 96,000 Ethereum options expiring, worth another $180 million. So what does this actually mean for us? Well, it means the market is temporarily paralyzed in a sluggish, mid-cycle bear phase as it digests nearly $1.5 billion in expiring contracts. Because of all this, Bitcoin's realized volatility has absolutely plummeted to a historical all-time low of just 25%. The market is barely even twitching right now, and implied volatility, that's dropped to levels we literally haven't seen since October of last year. Visually, I want you to picture this incredibly low volatility, like a tightly coiled spring. This extreme market compression is the calm before an explosive breakout. It's just building up immense potential energy, waiting for a catalyst to tip the scales. 25% volatility for an asset like Bitcoin is just not natural. And when that spring finally snaps, the move is usually aggressive. Section 3. Institutional moves and accumulation. All right, so while retail traders might be falling asleep at the wheel with this low volatility, the smart money is wide awake and highly active. JPMorgan just disclosed a staggering $355.7 million stake in BlackRock's spot Bitcoin ETF. To put that into perspective, they only had roughly $162 million in Q1. They have more than doubled their position in a single quarter, right in the middle of this exact sideways sluggish price action. And get this, it is not just Bitcoin. JPMorgan is aggressively accumulating across the board. They completely reversed their earlier exit and jumped right back into XRP through Bitwise and Grayscale funds. Their Ethereum stake, that skyrocketed 338% to $14.3 million. In a crazy twist, even as the broader U.S. spot Bitcoin ETF saw net outflows of over $61 million yesterday, major players like JPMorgan are quietly and methodically accumulating. They're using this coiled spring phase to build a rock-solid floor. Section 4. Regulatory mixed signals. Now, this institutional optimism is happening despite a seriously fractured regulatory battlefield. We have a stark contrast in Washington right now. On one hand, the CFTC is actually being proactive, scheduling an August 20th meeting focused on providing clear regulatory guidance for crypto and AI. But countering that, the SEC just indefinitely delayed its meeting on the regulation crypto rule and tokenization exemptions. This completely diverging timeline is a huge reason why broad-based risk appetite in crypto is currently capped. Outside of Washington, though, global infrastructure just keeps marching forward. Today, India officially launched its real-world central bank digital currency food subsidy system. Over in the markets, a brand new crypto neobank app launch, pushing Ether.fi up 13.7%, while promotional hype surged the Akedo token by 92%. On the flip side, however, Hawaii announced it's going to outright ban cash-to-crypto kiosks starting in October. So the ecosystem is definitely maturing, but man, it is a bumpy, hyper-localized ride. Section 5. The Q3 Market Outlook. So what does all this dynamic push and pull mean for the rest of Q3? Let's bring up some tactical data from Coinbase Institutional and Glassnode to scan the horizon. We really want to see exactly what the on-chain metrics are telling us about this current market phase. Take a look at this. Notice how the metric dips below the lower standard deviation band here in the shaded region. That is a massive signal for an accumulation zone. Underneath all the sluggish price action and boring sideways movement we just talked about, the on-chain data confirms that smart money and dormant long-term holders are quietly and actively accumulating. The supply is tightening up. Which leads us right into our next core concept, a clean market structure. If you look at the blue and gray areas tracking derivatives, open interest in perpetual futures and options is way below those late 2025 peak levels. This means leverage in the system has stayed completely subdued. The structure is unleveraged and remarkably clean, which dramatically reduces the risk of one of those terrifying cascading liquidation crashes. We are truly primed for a safe buildup. Tying it all together, the expert consensus from this data, and I'll quote Coinbase Institutional directly right here, is that we are neutrally transitioning out of a correction and firmly into an accumulation phase. They point out that the environment right now highly rewards a patient, defined risk approach. In other words, this is a time for calculated moves, not for chasing momentary, volatile pumps. All of this leaves us with the ultimate question to wrap up today's explainer. With macroeconomic forces colliding, regulators sending completely mixed signals, and heavyweights like JPMorgan quietly buying up the floor, what happens to the crypto market when this historic low volatility, this tightly coiled spring, finally snaps? The data tells us the foundation is poured, but the exact catalyst? Well, that remains the missing piece of the puzzle. Thanks so much for joining me today, and definitely keep a very close eye on these macro indicators in the days ahead.